Good morning everyone. Today we'll start with another concept in bond valuation called realized yield to maturity. So we have already seen current yield, holding period yield, money market yield, effective annual yield, bond equivalent yield, yield to maturity, and now one more yield we will see is realized yield to maturity. Okay. So what is realized yield to maturity? Let us understand that this is similar to modified IRR. This is similar to modified IRR. This is very similar to modified IRR. Okay. Have you studied modified IRR? Anybody modified IRR? So I'll first explain what is modified IRR and then we will solve question. Realized yield to maturity is a advanced version of yield to maturity. In realized yield to maturity, what we will do? Suppose there is a bond, maturity period is 4 years. In year 0, we are going to invest some amount, let us say 1000 rupees, and this bond will generate cash flows over 4-year period. Let us say bond will generate coupon of 80 rupees, 80 rupees, 80 rupees, and in the 4th year the bond will produce 80 plus 1000. We have to find realized yield to maturity. So under this concept we are going to assume that this cash flow will be reinvested. This cash flow generated from the bond will be reinvested at an appropriate investment rate. That is the rate of interest that will be available after 1 year. Or this 80 rupees will be reinvested for remaining period. That is, it will be invested for 2 years. This will be invested for 3 years. At the appropriate investment rate, this 80 will be reinvested for 1 year period at an appropriate investment rate. So on maturity date, we will calculate terminal value. What is terminal value? Terminal value means the future value of all these cash flows which were generated by the bond invested at an appropriate investment rate. Invested at an appropriate investment rate. So we will get a lump sum amount on maturity. Lump sum amount. We will get a lump sum amount on maturity. Let us say this amount comes to 1500 rupees. Only for example, let us say this amount comes to 1500 rupees on maturity. So now we have invested 1000 rupees today. We will get 1500 rupees after 4 years. It is like a 4th standard class 2 question that if you invest 1000 rupees today, if you receive 1500 rupees after 4 years, what is the annual compound rate of return? What is the annual compound rate of return? So this is like future value and this is like present value. So all of you know the formula. Present value is equal to future value upon 1 plus r to the power n. Okay. Now the student will tell me what is missing figure we have to find in this equation. What is the missing figure we have to find in this equation? What is the missing figure we have to find? The answer is right. Anup is right. He says we have to find R. R is the missing figure. R is that discount rate at which the present value of future value will be equal to 1000, and that R that we will find is called realized yield to maturity. So once again I will revise. In realized yield to maturity, cash flow generated will be reinvested for the remaining period at an appropriate investment rate. Calculate the terminal value here and then find out that discount rate at which the present value of terminal value is equal to the amount invested today, and that rate is called realized yield to maturity. It was called modified IRR in capital budgeting chapter. Okay, so first we'll read this theory note already written in the book, no need to write. The realized yield is the yield obtained by reinvesting all coupon payments at an appropriate interest rate. In case of YTM, what happens? You can get any YTM. You may get YTM of 13.6%, but it is not possible that all cash flow will be reinvested at the same 13.6%. YTM assumes that, YTM or IRR assumes that cash flows are reinvested at the same rate, but practically that is not possible. So therefore, we use an improved version of YTM, realized YTM, where cash flow will be reinvested at an appropriate investment rate. If coupons are reinvested at the market rate, the resultant yield is realized yield to maturity, also called modified IRR. So you will follow the following steps. All cash flows will be first brought to terminal value using an appropriate interest rate. This will give you a single stream of cash flow in the terminal year, which is called terminal value or lump sum amount. Then you have to find out that value, that is that discount rate at which the present value of the future cash flow, that is terminal value, is equal to the amount invested today. Realized yield to maturity is obtained by obtaining a single outflow in the 0th year and the terminal cash inflow as mentioned above. This is the realized yield. The discount rate which will equate the present value of terminal inflow to the 0th year outflow is called realized yield to maturity. Okay. So I will tell you one application of realized yield to maturity through this simple question number 6 square 36. So please come to question number 36, everybody. Okay, ready? Say yes. This question is from reference book. Source is reference book. To make the concept clear, a rupees 1000 par value bond carries a coupon rate of 10% payable annually and has a remaining maturity of 4 years. The bond is presently selling for rupees 1020. So you will have to invest 1020 rupees today. In year 0, you have to invest 1020. Okay. Then it says it has a life of 4 years. 4 years. 1, 2, 3, 4. Life is 4 years. And how much is the coupon? 10%. Coupon will be calculated on face value. So you will receive 100 rupees coupon in year 1, 2 and 3. And in the last year, you will receive 100 plus 1000 rupees. The bond is presently selling for 1020. Reinvestment rate applicable for future cash flow is 9%. So these cash flows will be reinvested for the remaining period at 9% rate. Cash flow of year 1 will be invested for how many year? Cash flow of year 1 will be invested for how many year? 1, 2, 3. So it will be invested for 3 years. Cash flow of year 2 will be invested for how many years? 1, 2. So this will be invested for 2 years. And this 100 rupees will be invested for 1 year. Is it right? And that way, you will first find the terminal value at the end of year 4 and find out the discount rate at which present value of this terminal value will be equal to 1020. Right? Is it understandable? So let us find out first terminal value. How much amount you will get if all cash flows were reinvested at the rate 9%. Step number 1 will write, step 1 write down calculation of terminal value. Calculation of terminal value. Draw this format first. Calculation of terminal value. First column write year, second column write event, third column write cash flow, fourth column write number of years, fifth column write calculation, last column value. Ready? If you are ready, we will start now. Understand year 1. In year 1, you will get coupon. In year 1, you will get coupon. How much coupon you will get? 100 rupees. 10% of 1000. And it will be invested for 3 years. Because year 1 is over. So it will be invested for 3 more years. You are here and you have to invest up to year 4. So the gap is 3 years. So invest it for 3 years. The future value you will get is 100 into 1 plus 0.09 to the power 3. Check the answer I have calculated. Is it 129.50? Is it 129.50? Okay. Now go to year 2, do the same thing. In year 2, you will receive coupon 100 rupees. Number of years for which this 100 will be invested will be 2 years. Future value 100 into 1.09 to the power 2. 100 into 1.09 to the power 2. So that comes to 118.81. 118.81. Then we'll come to year 3. Year 3 also same, coupon 100 rupees. Number of years, interest calculation 1 year. 100 into 1.09 to the power 1. What is the answer? The answer is 109. The answer is 109. Now in the last year, you will receive 100 rupees, but you are not going to invest it because this is the 4th year. This is the last year, so we are not going to invest it. So we'll keep it with us only. 100 rupees will remain 100. And one more thing, redemption value. You will get redemption value also. Redemption value is 1000 rupees. 1020 is the initial investment. 1000 rupees what you will get. Question is not clear about redemption value. Always assume redemption will be at par. So 1000 rupees will not be invested. It will remain with us. So what you do? Take the total of this last column. This is the amount we will get if it is invested at 9%. If all cash flows are invested at 9%. Okay. So please tell me what is the total? What is the total? Anybody for the total? Please reply fast. Today we are going to cover lot of concept. So the answer given by our student is 1457.31. You are right. 1457.31. There is one more method by which we can get this answer. By applying the formula of future value of annuity, you are receiving 100 rupees, 100 rupees, 100 rupees, 100 rupees 4 times. So this is called annuity. Annuity, same cash flow with same frequency. Same cash flow with same frequency is called annuity. So in your maths class, time value of money chapter, you have studied one formula for future value of an annuity. So I can find out the future value of all annuities by applying the formula, and then I will add 1000 rupees the redemption value. That will also give me the same answer. So try alternatively. Try alternatively. Suppose it's a 10-year problem, then the tabular format will take more time, formula will take less time, and this formula is not new to you. You have studied in maths classes also. Right. Future value of reinvested coupon at 9%. Future value of reinvested coupon at 9% at the end of the 4th year. Future value of reinvested coupon at 9% at the end of 4th year. So this formula is future value is equal to A into 1 plus R to the power n minus 1 in the numerator divided by R. Okay, this is the formula to find out the future value of annuity. So I will put the numbers and you will give me the answer. 100 into 1.09 to the power 4 minus 1 divided by 0.09. Please solve this and give me the answer. Anybody? Divya, Anup, Roshni. The answer is how much? Anybody answer? Check the answer. It is 457.31. 457.31. Is it right? So terminal value will be the future value of all coupon and plus the redemption value 1000. So you will get the same answer, 1457.31. So this method is very fast, but you have to remember this formula. This is the formula of future value of an annuity, 1457.31. Now you will understand what I have to do. This is the future value and 1020 is the present value. We have to find that discount rate at which the present value of this amount is equal to 1020 or the future value of this amount is equal to 1457.31, right? So write down below step 2. We'll write this formula of future value. You can write the formula of present value also, doesn't matter. Future value equal to PV into 1 plus R to the power 4. PV into 1 plus R to the power 4. So now I am going to write an equation. 1457.31 is equal to 1020 into 1 plus R to the power 4. This is power 4. 1 plus R to the power 4. And then we have to solve this equation. 1057.31 divided by 1020 is equal to 1 plus R to the power 4. then this calculation will be simplified. 1.4287 is equal to 1 plus r to the power 4. 1 plus r is equal to 1.4287 to the power 1 by 4, mathematics. And when the power is 1 by 4, you have to press square root function 2 times. So type this number, press square root 2 times, you will get 1.0933. 1.0933 is equal to 1 plus r, and therefore r is equal to 9.33%. 9.33%. Is it right? Just check, did you get the same answer? Yes. So those who have got it right, please say yes. This is realized yield to maturity. If the cash flows are reinvested at 9%, this is the rate of return you will earn, that is realized yield to maturity. So that was a very simple question. Now we'll take little advanced version of this. Come to question number 37. Question 37, consider a bond with the following features. Face value rupees 1000, coupon rate 14%, maturity 10 years, price 960, investor will hold the bond for 6 years. Oh, maturity is 10 years, but the investor will hold the bond only for 6-year period. That means we have to see what price the investor will get if he sells the bond at the end of 6 years. Expected reinvestment rate is 17%. That means these coupons that he will get will be reinvested at the rate 17%. Expected bond yield at the end of 6 years is 14%. Expected bond yield at the end of 6 years is 14%. That means after 6 years are over, in the market the yield is 14%. So the value of the bond will be calculated at the end of 6 years by calculating the present value of the remaining cash flow, which will be discounted at the rate 14%. So I have to calculate present value of bond at the end of 6th year, because the investor is going to sell the bond after 6 years. And for calculating the present value of the bond at the end of 6th year, I will discount the remaining cash flow using 14% discount rate, which is the expected yield after 6 years. Question is, calculate the expected total return from the bond. Expected total return from the bond is your realized yield to maturity, is realized YTM. Expected yield to maturity, expected total return is realized yield to maturity. So first you write down this diagram. First you draw this diagram, timeline. First we will draw this timeline. In year 0, you are going to invest 960 rupees. Year 0 will invest 960 rupees. Year 1, 140 you will receive as coupon. Year 2, 140 as coupon. Year 3, 140 coupon. Year 4, 140 coupon. Year 5, 140 coupon. Year 6, 140 coupon. Year 7, year 8, year 9, 140, and in the 10th year this bond will generate a cash flow of 1140. We have to find out what will be the value of the bond at the end of 6th year, and for that we will have to discount these cash flows by using 14% discount rate. You have to discount this cash flows using 14% discount rate. So two calculation I have to do here. First I have to calculate the future value of this coupon. Second I have to calculate at what price the bond will trade at the end of year 6. The total of the future value of coupon plus the value of the bond at the end of 6th year will give you terminal value, and then we'll calculate the realized yield to maturity. So this question will require one extra calculation, that is finding the present value of the remaining cash flow which the bond holder will get at the end of year 6 if he sells the bond at the end of 6th year. Understood? Any query on this? Any query? Yes or no? No query? Okay. So we'll go to step 1. Step 1 will calculate future value of reinvested coupon. Future value of reinvested coupon at 17% at the end of 6th year. At the end of 6th year. Future value of reinvested coupon at 17% at the end of 6th year. So write down the formula again. Future value equal to A into 1 plus R to the power n minus 1 upon R, and then you put the values. Annuity is 140 rupees. 140 into bracket 1.17 to the power 6 minus 1 upon 0.16. Please solve this one. Give me the answer. Everybody please try. We are calculating realized yield to maturity, on which we had got question in the exam also. That question also will take after some time. What is the answer? Anybody? Please reply fast. Any student? Yes, one Mr. Hari has replied. The answer is 1288.96. Anup has also replied. So this is right. Now go back to this diagram. We have to also calculate the present value of these cash flows, because this fellow is going to hold the bond only for 6 years. So at what amount he will be able to sell this bond? At an amount which is equal to present value of remaining cash flows discounted at 14%. So write step number 2, write down present value of remaining 4 years cash flow. Present value of remaining 4 years cash flow discounted at 14%. Present value of remaining 4 years cash flow discounted at 14%. So write down the formula. This is not a formula, this is just calculation. 140 into PV annuity factor at 14%, 4 years plus 1000 rupees redemption value into present value factor 14%, 4 years. So you will take your calculator and compute the PV factor at 14%, 4 years annuity factor. So 140 into 2.9137 plus 1000 into 0.59208. This will be the factor. Check, is it right? Is it right? So therefore the answer comes to 1000. Remember your first question. If the coupon rate is 14% and discount rate is also 14% and the redemption is at par, the present value will be equal to face value. So if suppose we don't have time, then we can directly write 1000 because coupon rate and discount rate both are 14%. So I will add these two numbers now. That will give me total cash flow at the end of 6th year. So step 3, total cash flow at the end of 6th year. Total cash flow at the end of 6th year. Total cash flow at the end of 6th year. You will add 1288.96 plus 1000. 1288.96 plus 1000. So how much is that? 2288.96. 2288.96 is right. 2288.96. Then write down next line. Now we'll have to solve an equation. Expected total return. Expected total return, same procedure will follow. Future value is equal to present value into 1 plus r to the power 6. This time we are holding the bond for 6 years. Okay, so the power is 6. I'll put the values and you will solve it for me. 2288.96 is equal to 960, which we have invested today, into 1 plus r to the power 6. So simplified, 2288.96 divided by 960 is equal to 1 plus r to the power 6. Further simplify, this will be 2298.96 divided by 960, 2.39475 is equal to 1 plus r to the power 6, which means 2.39475 to the power 1 by 6 is equal to 1 plus r. Okay, solve. How will you solve this part? First simplify that. 1 by 6 means 0.1667. 1 by 6 means 0.1667 is equal to 1 plus r. Got it? In your earlier lecture 1 and 2, I have told you how to crack this. One more time. First you type 2.39475. Then you press square root function 12 times. Then you press minus 1. Then you press multiply by the power 0.1667. Press plus 1. Press multiply equal to 12 times. Multiply equal to 12 times. You will get one factor 1.1559 on your calculator. Approximately you will get. Approximately. Just please check, are you getting 1.1559 by following this procedure? This is a shortcut technique on calculator. Is it right? Yes. Is it right? So it is equal to 1 plus r. So Devika has confirmed, Roshni has confirmed. So the answer will be r is equal to 15.59%. R is equal to 15.59%. 15.59%. Are you there on the other side? I am not getting response from all the students. So 15.59% is the realized yield to maturity. So this was little advanced version of the previous question, where you have to also compute the value of the bond at the end of 6th year. Okay. So should we go to the next question now? Is it clear? Presentation should be very good. All steps must be written. If you don't write the steps, you can probably lose few marks there. Okay. One more practice we'll do. Question number 38. Little fast this time because it is similar problem. Consider a bond with following features. Face value 1 lakh, coupon rate 10%, maturity 5 years, price is 1,02,300. Investor will hold the bond for 4 years. An expected reinvestment rate is 12%. Expected bond yield at the end of 4th year is 9%. Calculate the expected total return from the bond, which means you have to calculate same realized yield to maturity. So let us draw the timeline. You are going to invest 1,02,300 in year 0. Then in year 1 you will get 10,000 coupon. Write down. In year 2 you will get 10,000 rupees coupon. In year 3 you will get 10,000 rupees coupon. And in year 4 also you will get 10,000 rupees coupon. So you are going to invest these coupons for 3 years, 2 year, 1 year at the reinvestment rate which is 12%. And in the 5th year you will get 1,10,000. How did you get 1,10,000? 1 lakh is the face value, 10,000 is the coupon, and this you need to discount. This you will discount by using the expected yield 9% for 1 year, and you will get the terminal value or lump sum value at the end of year 4. So again 2 steps will follow. First we'll calculate the future value of coupon, then we'll calculate the present value of remaining cash flow, calculate the total and find the realized yield to maturity, right? So I hope you have drawn this format. Yes. Okay. So now write down step 1. Step 1 is future value of reinvested coupon at 12% at the end of 4th year. Everybody will answer this time. All the student will answer this time. Solve. Everybody will reply. Anybody who got the answer? Anybody who got the answer? The answer is 47793. Very good. 0.28. Roshni is right. 47793.28. And then you have to also calculate the present value of remaining 1 year cash flow. So step 2 write down. Step 2, present value of remaining 1 year cash flow. Present value of remaining 1 year cash flow discounted at 9%. Discounted at 9%. Discounted at 9%. So you will get 1,10,000. You will discount it at 9% for 1 year into PV factor 9% 1 year. So check on your calculator. PV factor 1 divided by 1.09 equal to 0.91743 something. So take 1,10,000 into 0.91743. Just confirm, are you getting same answer? 1,917.43. Is the answer right? Yes. So add this two number. Add this two number. The future value of coupon plus present value of remaining cash flow. That will give you the total cash flow at the end of fourth year. So step 3, total cash flow at the end of fourth year. Total cash flow at the end of fourth year. Total cash flow would be the sum of the previous two steps. Okay, check the calculation. Don't trust on my calculation. So this is your step 1. This is your step 2. Just tell me total is right. Is the total 148,710.71? Is the total right? 148,710.71. Is it right? Okay. Now write down step 4, expected total return. Step 4, expected total return. I will give you the formula. This time you will solve. And see, the power is 4. With the power is 4, you have to take square root 2 times. So future value is equal to present value into 1 plus r to the power 4. R to the power 4. I want to check whether you are learning or not. What is the answer? Yes, what is the answer? One student is saying 9.8%. Let me check. Yes, you are right, 9.8%. 9.8%. %9.8% is right. Many students have got it. So this is the answer of realized yield to maturity. Now we'll come to question number 39. Please note down as homework. Question 39. Today you will do homework. Have you completed the earlier homework? Have you completed the earlier homework? Say yes or no. So today you will complete all the homework. That will give you a very comprehensive learning. So question number 40. 40 number. A company had issued a bond at year 0 having a face value of rupees 1000. Coupon rate is 14%. Redemption value is rupees 1200 at any time of maturity during 5 years. Redemption value is 1200 at any time of maturity during 5 years. So if you redeem at year 1, you will get 1200. If you redeem at year 2, you will get 1200. If you redeem in year 3, you will get 1200. If you redeem at year 4, you will get 1200. Or if you redeem in year 5, you will get 1200. Now the question says, if the investor desires to get 17% return, that means required rate of return is 17%. Required rate of return is 17%. This is discount rate. What is the issue price? What is the issue price during each of the beginning of 5 years? Very easy question. So how many times you have to solve? You have to solve what will be the value of the bond at the beginning of year 1. what will be the value of bond at the beginning of year 2? What will be the value of bond at the beginning of year 3, beginning of year 4 and beginning of year 5? So basically, if you are valuing the bond at the beginning of year 1, you will take all cash flows which the bond will generate. If you are valuing the bond at the beginning of year 2, you will take cash flow of only 4 years. If you are valuing the bond at the beginning of year 3, you will value the bond on the basis of cash flow of remaining 3 years. So like the earlier problem, you will have to find out the value of the bond for the remaining cash flows. Value of the bond by taking remaining cash flows. So if you are here, we have all 5 cash flow remaining. If you are here in year 2, we have all the 4 cash flow remaining. So either we can solve by preparing 5 working notes, or can we prepare in a tabular format? Yes, Anup, can we prepare in a tabular format? Tabular format is right. So I am going to prepare in a tabular format. Okay. So write down, in one table we will get the answer. Calculation of issue price, write down. Calculation of issue price. Calculation of issue price. Draw this table. Draw this table. First column write beginning of the year. First column write beginning of the year. Then next column write number of years to maturity. Number of years to maturity. Number of years to maturity. Then write down present value annuity factor at 17%. Present value annuity factor at 17%. Then write down present value of coupon. Present value of coupon at rupees 140. Present value of coupon at rupees 140. Present value of coupon at rupees 140. Then write down present value factor. Present value factor in bracket maturing, matching with maturity. Matching with maturity. Then next column is present value of maturity. Present value of maturity, that is 1200 into PV factor. And the last column is PV of all cash flows. Last column is PV of all cash flows. Is right? Column numbers write down 1, 2, 3, 4, 5, 6. Column number, and 7 will be 4 plus 6. 4 is the present value of coupon and 6 is the present value of maturity. Is right? So now you write down first answer, beginning of year 1. If I have to value the bond at the beginning of year 1, the number of years to maturity are 5. 5 years are still remaining. Year 1, 2, 3, 4, 5 are remaining. So tell me the annuity factor at 17% for 5 year. Try. 1 divided by 1.17 equal to memory plus equal to memory plus 5 times. Then memory recall. So what is the factor? You are getting 3.1994. Is it right? Yes. Then multiply 3.1994 into 140. That will give you present value of coupon. That will give you present value of all future coupon. So that comes to 447.92. Then calculate the PV factor for 5th year. P factor for 5th year. 1 divided by 1.17 equal to 5 times. So that is the factor for 5th year. And in the 5th year, we will get 1200 rupees. So I'll multiply 1200 into 0.4561. 1200 into 0.4561. So that will give me present value of maturity value 547.32. Now you will add these two numbers. So this is like solving a simple question of a 5-year bond in just one line, and that total comes to 995.24. Is right? 995.24 is right? Yes. So now tell me year 2. How many years are remaining? 4. Calculate the factor. Calculate the factor for 4 year and 17%. Annuity factor. Use M plus function. 2.7433. Multiply by 140. 384.06. Now calculate the 4th year factor at 17%. 4th year factor 0.5337. 0.5337 multiply by 1200. Multiply by 1200. 640.44. Then you add PV of coupon and PV of redemption value. 1024.50 is right. Then 3. Number of years remaining also 3. Beginning of year 3 means year 3, 4, 5. 3 years are remaining. Come on. Factor. Write down the factor 2.2096. 2.2096 multiplied by 140. 309.34. Very good. Come on. 3rd year factor 0.6244 multiplied by 1200. How much? 749.28. Add these two numbers. That will give you the value of the bond at the beginning of year 3. 1058.63. Now try 4th year. You will try and give me the answer. Let me see who will give me the correct answer here. Try fast. Anybody who got the answer? Any answer? Now 2 years are remaining. Factor is 1.5852. Present value of coupon 221.93. Second year factor 0.7305. 1200 into 0.7305. 876.60. Take the total 1098.53. And now we are at the beginning of year 5. So 1 year is remaining. Factor for 1 year will be 1 divided by 1.17. 0.8547. 0.8547 into 140. 119.66. Again same factor because only 1 year is remaining into 1200. 1025.64. And therefore the answer will be now 1145.30. Is it right? Is it right? So what is your observation? Last column, observation. As we are approaching maturity, as we are approaching maturity, the value of the bond is approaching its redemption value. The value of the bond is approaching its redemption value. The redemption value is 1200 rupees. So in the 5th year it is 1145.30. So as you reach closer and closer to maturity, the value of the bond will also move closer and closer to the redemption value. This note was written in some earlier paragraphs also. So is this answer right? Is this answer right? Can we go to the next question now? Okay, so now we'll come to next very important question, because it's from exam. Very important 41 number question, May 2009 exam, for 8 marks. 8 marks. You can easily score these 8 marks. Okay. So are you ready for this 8 marks? Say yes. Consider 2 bonds, but little lengthy, but you can solve it. There are 2 bonds, so 2 problems we have to solve in one, 2 in 1. One with 5 years to maturity and the other with 20 years to maturity. So 2 bonds, one has 5-year maturity, other 20-year. Both the bonds have a face value of 1000 rupees. Coupon rate 8%. Annual interest payment. And both are selling at par. Very important hint here. A face value is 1000 rupees. Trading also at par. Coupon rate is 8%. So can you tell me what is YTM or required return of this bond? I am asking you, everybody will reply. What is the YTM or required return if the bond is trading at par? If the bond is trading at par, the required return and coupon rate will be same. So the answer is 8%, which is not given in the problem. The student has to know this concept that if the bond is trading at par, then coupon rate and required return or discount rate will be 8%. So my original answer is 8%. Now assume that the yield of both the bonds fall to 6%. So from 8 to 6. Whether the price of the bond will increase or decrease. First question, remember, first question. There is an inverse relationship between the yield and the bond price. Lower the yield, lower the discount rate, higher will be the price of the bond. True or false? So the answer is, if the discount rate reduces, the bond price will increase. Then one more question. What percentage of this increase? What percentage of this increase or decrease comes from a change in the present value of the bond's principal amount, and what percentage of this increase or decrease comes from a change in the present value of the bond's interest payment? So what portion of the increase is due to change in the present value of the bond and the present value of the coupon, and what portion is due to change in present value of the principal? So you have to identify how much the coupon has contributed, how much the principal amount has contributed in this change. Okay, so first you write down 2 notes. First write down note number 1. First write down note number 1. As the bond is trading at par, as the bond is trading at par and redemption is also at par, redemption is also at par, and redemption is also at par, the YTM is equal to coupon rate is equal to 8%. YTM is equal to coupon rate is equal to 8%. So it means my original YTM was 8%. Have you written this note? Have you noted down? Say yes. Now I will write second note. First I need to erase this. Second note, write down. There is inverse relationship between YTM and bond price. There is inverse relationship between YTM and bond price. If YTM decreases, bond price will increase. If YTM decreases, bond price will increase. Now I need to calculate what is the change in the bond price. Out of that change, how much change comes due to change in present value of coupon and how much change comes due to change in present value of the principal amount. So one by one we'll solve. First we will solve 5-year bond. So write down, next line heading, write down before a table, calculation of PV of 5-year bond. Calculation of PV of 5-year bond. Calculation of PV of a 5-year bond. Now I have to do two calculation, one at 8% discount rate, one at 6% discount rate, because I have to see how much change occurs in principal and in coupon. Okay, so both in one table. So first we'll do the calculation at 8% discount rate, and then we'll do calculation at 6% discount rate, and then we'll calculate the change. Same way you will do for 20 years also. So write down the format first. Year, any other format is welcome if you are getting the same answer. Year, particulars, cash flow, discounting factor at 8%, DCF. DCF means discounted cash flow or present value. Then discounting factor at 6%, present value, and then change. Change will be the difference between this and this. How much is the change in coupon, how much is the change in the principal amount. So please write down, it's a 5-year bond. The first question is 5-year bond. Year 1-5, coupon, interest write down or coupon write down, either. How much will be that? 8% of 1000, 80 rupees. Calculate the annuity factor at 8% for 5-year. Annuity factor at 8% for 5-year. So that will come to 3.993. Check the answer, 3.993. And in year 5, you will get face value 1000 rupees. Calculate the factor at 8% for 5th year. So that is 0.681. Multiply and take the total. Multiply and take the total. So multiply 319.44, 681, total should be close to 1000. Total should be close to 1000 because coupon rate is also 8% and discount rate is also 8%. So actually the answer should have come 1000. But because of the rounding off in the discounting factor, there is some difference, no problem. Is it right? Is it right, everybody? So now we'll go to 6%. Suppose the YTM changes from 8 to 6. So again calculate the annuity factor at 6% for 5 years. Check 4.212 is right, 4.212, and fifth year is 0.747. Fifth year is 0.747. Now again multiply 80 into 4.212. 80 into 4.212. So you will get 336.96. So what happens to the bond value when the YTM changes? That is the question. This is 747. Take the total 1083.896. So one thing is confirmed, the bond price will increase. When YTM will reduce from 8 to 6, bond price will increase. Okay, now the question is, how much is due to change in interest and how much is due to change in face value? So take the difference between these two numbers and write in the change column. So it is 17.52 in the interest and 66 in the face value. Total change is 83.52. But out of that 83.52, this change is in coupon, this change is in face value, but we have to convert into percentage. Question is not the amount of change, but the question is percentage of change. So I will have to write down percentage increase due to change in PV of interest. Percentage increase due to change in PV of interest. So percentage change will be 17.52 divided by 83.52. That is 20.98%. Is right, 20.98%. Check the answer. And percentage change due to change in PV of face value. Percentage change due to change in PV of face value. Percentage change due to change in PV of face value. 66 divided by 83.52. 79.02. So which have contributed more? The change in face value has contributed more towards the change in the present value of the bond. If it is a 5-year bond. Now we'll do the same exercise for a 20-year bond, and let us see in 20-year bond who contributes more, the coupon or the face value. Is the answer right? Is the answer right? Okay, now just repetition of the same thing for a 20-year bond. Next line write down calculation of PV of 20-year bond. Calculation of PV of 20-year bond. Draw the same format, just exactly same format you will draw, but this time number of years are 20. Number of years are 20. Okay. After drawing the format, solve yourself. I'll check the answer later. Solve yourself. These are the cash flows. Little fast. Come on. Yes, come on, fast. You can do it. In the exam, you have to present your answer very nicely. That helps you to score high marks. Okay, anybody, what is the answer here? It should be close to 1000 again, because coupon rate and discount rate are same. Are you getting 1000 at 8%? You should get close to 1000. 1000 is accurate. Close to 1000 is also okay. Now we'll try 6%. Anybody who got the total of DCF column at 6%? Total, please reply fast. Check the factors. Check the total. Are you getting 1229.39? How many of you got this answer? Just say yes. One two two 9.39. Got it? Okay. So tell me the change in the interest portion now. This is the change. 131.99. Take the change in the principal portion. 97.20. Very good. And take the total. The total is 229.19. Total is very high, 229.19. Now calculate the percentage increase due to change in PV of interest. This time you will find the coupon has a bigger impact. This time coupon has a bigger impact because the term to maturity is higher here. 131.99 divided by 229.19. So is it 57.59%? Right. Then calculate percentage increase due to change in PV of face value. Come on, Divya. Is the answer 42.541%? Yes. So this time who has contributed more towards change in the present value? The coupon. So what is your observation? If the term to maturity is high, the change in present value of coupon will be more. If the term to maturity is low, the change in present value of principal will be more, and that is how the bond values get impacted. Right? So this was an 8 mark, very easy question. With practice you can get full 8 marks. So now we'll discuss something interesting. It is called bond theorem. What is theorem? Theorem means universal truth. So I am going to discuss certain properties of bond which are applicable in all situations. As long as these conditions are fulfilled, the bond value will react accordingly. First theorem is, which we have already covered in question number 1, the price of a bond is, in your book, inversely related to the yield to maturity. Do you agree? Okay, do the voting. Yes, we agree. B, no, we don't agree. So a student is saying yes, we agree. So how many of you agree? All of you? Just now we have seen in the question number 41 also. But in order to demonstrate that yes, this theorem is correct, we are going to take three discount rates, 9, 10, 8. When you will move from 9 to 10, bond price will fall. When you will move from 10 to 8, the bond price will rise. So this question I am going to solve. Take out your notebook again. We have a question where we have a bond with face value 100, coupon rate 8%, number of years 10, and the three situations are 9, 10 and 8. This is similar to your question number 1 we had solved. So first we will calculate the present value of the bond under all the three YTMs, and then we will see whether this theorem is true or not. Write down in your notebook, write down theorem 1 example. Calculation of present value of the bond. Calculation of present value of the bond will follow the same format. In one table only will solve all the three. Right? Year, cash flow, discount rate 9%. Under that two columns, discounting factor, discounted cash flow. Then discount rate 10%. Under that two columns, discounting factor, discounted cash flow. Then discount rate 8%. Under that two columns, discounting factor, discounted cash flow. Have you drawn the format now? So write 1-10, the bond has 10-year life. Coupon will be 8% of 100. Coupon will be 8% of 100, 8 rupees. And year 10, redemption value 100 rupees. So just use your calculator little fast. What is the discounting factor for 10 years at 9%? Is it 6.4177? Is it 6.4177? Say yes. Then 10th year is 0.4224. Check the answer. Multiply and take total. Multiply 51.342 42.24. Take the total 93.582. Is right, Divya? Very good. 93.582. Now try the same thing for 10%. 10% factor 6.1446. Correct? 10th year factor 0.3855. Multiply 8 into 6.1446. So you will get 49.157. 49.157 and 38.55. Take the total. Is it around 87.707? Yes or no? Yes. And now you try 8%. This is you will try, I will wait. Try 8%, everybody. Give me the total of last column. Those who are studying online can write the answer in chat box. What is the answer of the last column? first you write the factor, then take the total. It should come to 100 rupees. Why 100 rupees? Because the discount rate and the coupon rate both are 8%. So you will get same answer, 100 rupees. Okay. So all of you got this answer 100 rupees, right? Now you see the observation, when discount rate has increased, bond price has decreased. When discount rate has decreased, bond price has increased. So that proves my theorem number 1, that the price of the bond is inversely related to yield to maturity, and that is simple thing. In present value, higher the discount rate you will take, lower will be the present value. Okay, now there is another interesting theorem, theorem 2. Okay, the increase in the price of the bond when the interest rate goes down. All of you have seen, when the market interest rate goes down, here interest rate means market interest rate, required rate of return. So when the market rate will fall, the bond price will rise by a certain percentage, is greater than the decrease in its price, when the interest rate goes up by the same percentage. So when bond price, when the interest rate falls, bond price rises. When interest rate rises, bond price will fall. But the change in the bond price in percentage term is not equal. Change in the bond price in percentage term is not equal. For example, let us say right now the market rate of interest is 9%. So it can fall to 8%, it can rise to 10%. So bond price will change. Here the bond price will increase, here the bond price will decrease. Already we have seen. But my question is whether the percentage increase in bond price for 1% fall in YTM will be same as percentage decrease in bond price for 1% rise in YTM. The answer is no. The answer is no. The percentage increase in bond price for 1% fall in YTM will be more than the percentage decrease in the bond price when the YTM increases by 10%. And why does it happen? This happens because the curve is not a linear curve. It is a curvilinear. Okay, and that because of that, even if the YTM changes by 1% on either direction, the percentage change in the bond price is not equal. To prove our point, we'll take this example. Face value of the bond is 100 rupees, coupon rate 8%, number of years 10 years. So this I have kept same as our example earlier, and there are 3 YTM also I have kept same. So good news is that the calculation of the present value we have already done here. Can you see here? We have already done the calculation in your first example. So only I need to compute the percentage change. One percentage change I will compare these two number, and in second I am going to compare these two number, and I am going to prove that the percentage change in bond price is not equal even though YTM has changed by 1% on either side. Okay, so write down the answer for theorem 2. In your notebook write down. Already we have done the calculation, so I am not spending time on calculation part. Answer of example of theorem 2. Answer of example of theorem 2. Write down the appreciation in the price. The appreciation in the price when interest rate fell from 9% to 8%, when interest rate fell from 9% to 8%, when interest rate fell from 9% to 8%, go to your earlier table. When interest rate goes down from 9% to 8%, the bond price has gone up from 93.58 to 200 rupees. So the change in the bond price is 100 minus 93.582 divide by 93.582, convert into percentage, multiplied by 100. So check whether you are getting 6.858%. 6.858%. And now we'll also see depreciation. Depreciation means decline. Depreciation means decline. So you can just write in bracket decline. Depreciation or decline when the market interest rate goes up from 9% to 10%. Refer the previous table. Now the market price of the bond has gone down. So the change is 93.582 minus 87.707 divided by 93.582. 6.277%. 6.277%. Can you see that this is higher than this one? Okay, this change is higher than this. So when the YTM falls, bond price rises. When the YTM rises, bond price falls, but the rise is more than the fall for the same change in YTM. Okay, this I can understand with the help of this diagram also. So draw this diagram now. Draw this diagram. On x-axis write yield to maturity. On y-axis write down price. On y-axis write down price and draw this curve. This curve shows the relationship between bond price and yield to maturity. So draw this much first. Keep your calculator, pen, pencil, eraser, everything ready. Now, right now the YTM is Y. Understand the diagram. The YTM is Y and the bond price is P. But suppose YTM decreases. It decreases to Y1. So what will happen to the bond price? Bond price will increase to P1. Bond price will increase to P1. Bond price will increase to P1. Draw this also. And suppose the YTM increases by same percentage, it becomes Y2. Bond price will decrease. Bond price will decrease to P2. Bond price will decrease to P2. You can see here this P1 minus P is the change in bond price when YTM falls, and this P minus P2 is the change in the bond price when YTM increases. So can you say P1 minus P in this diagram, you can easily see, is greater than P minus P2. With the help of the diagram also, I am able to convince you that the change in the bond price will be more if YTM falls, and this property of the bond is called convexity. This property of the bond is called convexity. This curve is a convex. Okay. So I am sure you have drawn the diagram. Have you drawn the diagram? Have you understood? Say yes. Okay. So this property of the bond is called convexity. How to calculate convexity is also a part of our syllabus. That we'll discuss afterwards. Okay, so there is one more area that is to be discussed, is how to calculate that convexity and how to use the convexity to estimate the bond prices. If we know the convexity, we can estimate the bond price for a given change in YTM. So this was my theorem number 2. What is theorem 3? Longer the term to maturity of a bond, higher will be its price sensitivity. Longer the term to maturity, higher will be the price sensitivity. It means that if suppose there are two bonds, one has a maturity of 10 year and one has a maturity of 7 year, and YTM changes by 1% from 9 to 10. Change in YTM is by 1%. But the bond which has longer term to maturity, its price will fall by a higher percentage. Longer bonds are riskier because for a given change in the YTM, their prices fall by a higher percentage, and that is what we have to prove. So this example, write down in the notebook. First you see, bond A we have already calculated in our example 1 with the same data. Can you see that? 100 rupees, 8%, 10 year, and we have already done the calculation at 9% and 10%. So I will save time by not solving bond A, already done in first example. Okay, so this was my bond A. You have the answer with you, 93.582. Don't write 87.707. You have done this in example 1. Only calculate the percentage change. Write down. Bond B write down first in the answer. Bond A don't write, we have done it. So write down PV of bond B. In bond B I have changed one feature. Number of years I have taken 7 years now instead of 10. So student will check my answer and tell me whether it is right or not. Write down year, cash flow, discount rate 9%. Under that we will draw two columns, discounting factor, discounted cash flow. And then we'll write discount rate 10%. Under that two columns, discounting factor, discounted cash flow. It's a 7-year problem now. So 1-7, cash flow is 8 rupees, 7th year cash flow is 100 rupees. Check the factor yourself. On your calculator, check the factors. If you think it is right, then write down and solve. Anybody who has done the calculation at 9%, please tell me, is it right? 94.96, is it right? Yes, 94.96. Then you try 10%, try 10% and check the answer. Try 10% and check the answer. Is it 90.26? Is it 90.26? Yes. So all the students have got the same answer. Now write down below the table those who have done percentage change in price of bond A. Percentage change in price of bond A. So go to your earlier example 1, where you will find 93.58 and 87.7. Divide by 93.58. So that comes to 6.28%. Check the answer, 6.28%. Now tell me, by what percentage bond price have changed for bond B? Percentage change in price of bond B. Percentage change in price of bond B. Take the difference between these two numbers, divide by 94.96. So your answer is how much? 4.95. What is the proof here? The proof is that if a bond has longer term to maturity, it will be more price sensitive for a given change in YTM. That is why we say long term bonds are riskier. If the YTM changes, their value will change by a higher percentage. Okay. Of course, there is an advantage also in long term bond. If the YTM falls, what will happen? If the YTM falls, the bond price will rise, and the bond price will rise more in case of long term bond. So if from risk point of view, it is very risky compared to a bond with shorter term to maturity. But yes, if the YTM will fall, the bond price of a longer term to maturity will rise by a higher percentage. And one more theorem I will take, theorem number 4. Between two bonds of the same maturity, now maturity is same but different coupon, but coupon rates are different. The bond with lower coupon will experience more price sensitivity than the one with higher coupon. So what does it mean? Suppose there are two bonds, all features are same, face value same, year same, but coupon rates are different, and YTM changes from 9% to 10%. So bond price will fall. Now guess, based on this theorem, whose price will fall by a higher percentage? Please reply. Whose price will fall by a higher percentage? Bond A or bond B? So bond B, because the bond which has lower coupon will experience more price sensitivity. Now we'll solve this. Bond A I am not going to solve, because bond A I have kept same like example 1. Only bond B I am going to solve, and I am going to demonstrate in front of you that this theorem is right. Okay. So write down bond A I will not write, bond B write down. PV of bond B. Bond A is already calculated in our first example. So I request the student little fast, solve bond B. Solve bond B. Solve for bond B on your own. On your own, try. Check the answer at 9%. Write down nicely in the notebook. Write down very nicely in the notebook, because when you will revise, it will be very useful. Then you don't have to do any calculation. Everything will be there in the notes. So anybody who can tell me 80.75, is this right? Is right 80.75? Yes, 80.75, is it right? And 75.42, check, is it right? Say yes. Okay. So this is right. Now we'll go to percentage change in price of bond A. Percentage change in price of bond A. already calculated, you can just write down 6.28%. Bond A I am keeping same to save our time. Now write down percentage change in price of bond B, percentage change in price of bond B, percentage change in price of bond B, 80.75 minus 75.42 and divide by 80.75. So tell me what is the answer? Anybody, any answer? 6.6%. Again you see the observation, bond B has shown higher price sensitivity because it has lower coupon. Now why we are learning bond theorem? This kind of knowledge is very useful for fund managers, those who manage the funds by investing in bonds, because if they know which type of bond will have higher risk, they will try to avoid that kind of bond. Recently in USA, a bank called Silicon Valley Bank, it got collapsed, it got liquidated because they had invested in long-term bond, and US Federal Reserve has increased the interest rate, which was nearly 0% to around 5%. So if the market rate will move from 0 to 5%, such a big change, the bond values fall down. The value of the bond held by this bank has gone down by billions of dollars, and that is why that bank had to wind up. Okay, so it can be such a big risk that one of the banks in USA had to wind up because of this fluctuating interest rate. Right now globally the interest rates are fluctuating a lot, and that is why those who are holding bond, the value of the bond is also changing a lot. So this is the purpose of bond theorem. Now next paragraph, just a theory question. Sometimes they may ask you, what are the risk of investing in bonds? Not very important, but still, as an investor in any security, I should know what kind of risk I am taking. Generally people believe that bonds are not risky. That means your parents have told you, invest in this government bond and we are safe. No, you are not safe. There are some risks that you are carrying. First risk we will see is market risk. If the market rate of interest increases, the bond price will fall. The example I have already given to you, Silicon Valley Bank were holding long-term bonds. The US Federal Reserve has increased the interest rate. The value of their bonds have gone down. It has gone down to such an extent that they can't pay their liabilities. And therefore, the depositors lost confidence in the bank and the bank had to wind up. So that is market risk. Second risk is called call risk. Second risk we will call, or second is here, reinvestment risk. What is reinvestment risk? Suppose you invested in a bond. The day you invested, the interest rate was 14%. You are very happy that I am getting 14% interest rate on a bond. When they give you the coupon and you go to invest in the market now, the market rate has gone down to 9%. So you will not be able to reinvest the coupon at the same rate. You will not be able to reinvest the cash flow at the same rate. That is called reinvestment risk. The third risk is call risk. This risk is attached to a callable bond. We are going to take callable bond in the next lecture probably. Callable bond is a bond where the company has the right to call back the bond before maturity. Is it right? When will company call back the bond? Company will call back the bond when the market rate of interest has gone down. At the time of issue of the bond it was 14%, but later the market rate is 9%. So company will call back the old bonds and issue new bond. But to the investor who was enjoying a 14% interest rate, now he will not be able to enjoy the same high rate of interest. company will redeem the bond. That is called callable bond. It is very difficult also to sell such callable bond. Fourth bond, credit risk. Company can default. If you invest in bonds of certain companies, they can default. Even in case of certain government also, they can default. Recently in USA, it was almost probable that the government will default on payment of its obligation. But then the US Senate and the President, they came together and they increased the limit of borrowing, and the US government survived. So if it can happen to a US government, it can happen to any company. So many companies can default on their bonds. So before you invest in a bond, read their credit rating, read their history of making payment on time, and then invest in a bond. Otherwise, the company can default on the bond. And don't trust the government also. Even governments have defaulted on payment. Next is a very severe risk of investing in bond is inflation risk. Now what happens? Suppose you invest 100 rupees in a government bond, they will pay you 6 rupees interest, you will get 106 rupees after 1 year. But suppose the inflation is 8%. Inflation is 8%. So what you could have bought with 100 rupees a year ago, now you will be able to buy it only for 108 rupees. So you redeem your government bond, you get 106, and when you go to buy the same basket of goods and services, you have to pay 108 rupees. So you are not gaining anything by investing in a government bond if the inflation is higher than the interest they are paying. If the inflation rate is higher than the interest they are paying, you are not actually earning in real sense. You are earning nominal rate, but your real rate of return is negative. And the last, which is a very dangerous risk, liquidity risk. Sir, what is liquidity risk? Liquidity risk means you will not be able to sell the bond. You will not be able to convert your bond into cash if you want it. For example, in India, if you want to suppose get tax deduction under section 80 or under that capital gain bond, you will have to invest in certain government security which will have 5-year lock-in period, like National Savings Certificate or that rural infrastructure bond or something, National Highway bond, 5-year lock-in. Your money gets locked for 5 years. You are not able to use that money. So you will be having lot of trouble when you need money and you find that I am not able to use that money for a certain time period, and that is called liquidity. You will not be able to pay your liabilities even though you are holding bonds. So that is why before you invest in bonds, check the liquidity also. Will I be able to convert it into cash if I want it? So that I have briefly summarized for you. Now we'll come to next discussion, which is a very long discussion, and lot of questions in the exams are asked on this concept of duration of a bond. Have you heard this term, duration of the bond? Duration of a bond is not equal to maturity of the bond. To understand duration, let us understand one story. Okay. So there are two friends, Divya and Devika. There are two friends, Divya and Devika. Divya asked Devika, can you lend me 3 lakh rupees? Can you give me a loan of 3 lakh rupees? So Devika says, yes, I can give you 3 lakh rupees loan. But you have to pay it like this. you have to pay 1 lakh rupees after 1 year, 1 lakh rupees after year 2, and 1 lakh rupees after year 3. Devika gave a loan of 3 lakh rupees to Divya. Divya will pay 1 lakh, 1 lakh, 1 lakh in year 1, year 2 and year 3. Understood? So what is the duration of the loan? The question is, what is the duration of the loan? The answer is not 3 years. The answer is not 3 years. 3 years is the total time period in which the loan will be repaid. But if you look at it very carefully, very closely, you will find that Devika has not given one loan to Divya. Devika has given 3 loans to Divya. Devika has given 3 loans to Divya. 1 lakh loan for a period of 1 year, 1 lakh rupees loan for a period of 2 years, 1 lakh loan for a period of 3 years. So what is the answer? Duration is not equal to 3 years. Duration is the weighted average maturity of the loan. Duration is the weighted average life of the bond. So how do I compute the duration? Just for simplicity right now, I am ignoring the present value. Otherwise, we'll have to do the present value calculation. But for a second, ignore the present value part. I will multiply. This is my year. This is my cash flow. I'll multiply. These cash flows will be used as weights. Cash flow will be used as weight. So multiply 1 into 1, 2 into 1, 3 into 1. Take the total 6. Take the total of the weights. Cash flows are being used as weights. It's a weighted average because if the amounts are different in different year, the weights will also change. So this is 3 lakh. So duration is the weighted average life of the bond. So in our example, duration will be 2 years. It is the weighted average life of the bond. Duration means since you have recovered some amount in earlier year, so life of the bond is not 3 years. The weighted average life of the bond is 2 years in our example. So now I will explain the concept with the help of these notes printed in the book. There is a heading called summary. Okay, very good, Anup. The duration will be less than 3 years. Duration is a measure of weighted average life of the bond. This is weighted average life of this loan, which considers the size and the timing of each cash flow. In our example, the size of the cash flow I have kept 1 lakh and the timing of the cash flow is 1 year, 2 year, 3 year, 4 year, like this. The weight assigned to each period is the present value of the cash flow. Only for simplicity I have not taken present value, but while solving the question I will do that. So I will take present value of the cash flow, which is used as a weight at that time as a proportion of the price of the bond. Duration is the average time taken by an investor to collect his or her investment. So Devika has given a loan to Divya. The average time taken by Devika to recover her loan to Divya is 2 years. The average time taken is 2 years. Some amount was recovered in year 1, some amount was recovered in year 2, some amount was recovered in year 3. So the average time taken to recover her investment is 2 years. Okay. Now the same thing applies to a bond also. Suppose this is a bond. It has 4 years maturity. It pays you coupon, and in the last year it pays you coupon plus redemption value, and they ask you to compute the duration of the bond. So what you will do, first you will compute the present value of cash flow. Okay, let us say the discount rate is 10%. So you will help me with the present value. 60 divided by 1.10. So this will be 54.55. This will be 49.87. Check. This will be 45.08, and then the last one will be 723.99. So this is called present value, and now you multiply year into present value. Multiply year into present value. 54.55, 2 into this number. We will solve a question after this, don't worry, but I am just telling you how to calculate duration, and then I am also going to tell you what is the purpose of calculating the duration, because without knowing the purpose there is no charm in learning. So 135.24, and the last one is 4 into, since you are not helping, I have to do myself. Last one is how much? 2895.96, something like this. Then you will take the total of these two columns. Okay, so can you tell me the total of this column? Can you tell me the total of this column? 54.55 plus 49.87 plus 45.08 plus 723.99. So that is 873.49. Very good. Can you tell me the total of the last column also? Total of the last column. So Divya is saying 3186.49. For the timing, I am assuming it is correct. Okay. So in this case, the duration will be equal to 3186.49 divided by 873.49. So tell me how much is that? Yes, Roshni, what is the answer? 3186.49 divided by 873.49. Come on. 3.647 years. 3.647 years. Okay. So this is called weighted average maturity of the bond, or average time taken by an investor to collect his or her investment. For a coupon bond, it is always going to be less than the term to maturity. Why? Because some cash flows are recovered in the earlier years also. If you are able to recover some cash flow in the earlier year, the duration will be lower than the term to maturity. Is it right? You can present the answer in one more way. How you can present the answer in one more way? First you will calculate the present value, and after calculating the present value, you will convert into weights. How do you assign weights? 54.55 divided by 873.49. So the weightage given to this is 0.0624. Then you will take 49.87 divided by 873.49, and the weightage to this cash flow will be 0.057. Then you take 45.08 divided by 873.49 is equal to 0.0516 or something. and similarly the weight assigned to the last cash flow will be 723.99 divided by 873.49, that is 0.8288. Now what you will do, you will multiply weight into year. You will multiply weight into year. So I am just writing here weight into year. So that is also one way to solve. It takes little more time, so I avoid it because it requires one extra calculation. So 1 into this weight 0.0624, 2 into 0.057, please tell me what is the answer, 0.114, then 3 into 0.0516 equal to 0.1548, and the last one 4 into 0.8288 equal to 3.3152. Anybody wants to give me the total here? The total should be same like the previous answer, 3.64. Okay, the total should be approximately same. Are you getting same total? So if you are comfortable using this format, you can follow this, or without writing weight only, you can multiply year into present value and take the total, divide by total of present value. This is the mechanism to calculate the duration, which we have learnt till now mechanically. But as we'll go ahead today and some portion of the lecture tomorrow, you will see that this duration is an amazing concept and you can use it to understand the risk involved in the bond. You can use it to protect yourself from the risk which are there in the bond. But as we'll go ahead, we will learn. So first task is, what is duration? It is the average maturity of the bond, time required by an investor to recover his or her investment. Okay. Second thing, we have learned how to calculate the duration. So duration can be calculated by taking the sum of year into PV of cash flow divided by sum of PV of cash flow. This is what we did. Now I am going to apply this formula of duration by using this question. Question number 42 is for experiment purpose, concept problem, and then we will use this question as a base for developing more concept. Are you ready? Are you ready? Say yes, we are ready. And then we'll solve this question. Calculate the, we are just right now learning the calculation. Application is after this. Duration of a 6%, 5-year bond, given YTM is 8%, face value is 1000. So right now I am going to do this calculation. Later on we are going to also calculate modified duration and also calculate the revised bond price if the YTM reduces by 0.5%. These two part we will discuss later. First we will solve this part, and after solving this answer you will keep half page blank for these two part. Okay, these two part will solve a little later because we need to learn more concept. So first we are going to only see how to calculate the duration. Right, I think I have yes, write in the notebook question number 42. Question number 42, please write down and keep calculator ready because next 1 hour will be heavy load, calculation oriented question. So duration of the bond is the weighted average life of the bond, where the present value of cash flow is used as weights. First write down heading duration of the bond, then write down a table with 5 columns. We will follow this format. Otherwise you can convert present value into weights and then multiply by year. That takes little more time, and time is the most important resource in the exam that we have. Right, year, cash flow, discounting factor at 8%, present value into year, present value into year. Now year, write down 1, 2, 3, 4, 5. Write separately because each year will have different weight. Don't write 1-5 because each year will have different weights. Okay. Cash flow, write down 6% of 100, 6% of 1000, 6% of 1000 is 60. In the last year, you will write 60 plus 1000. In the last year, you will write 60 plus 1000, 1060. Now next is, take your calculator, 1 divided by 1.08 equal to 0.9259. Again press equal to 0.8573 equal to 0.7938, 0.7350, 0.6806. Now just multiply and add. Do it yourself little fast. Let me see who will give me the total here first. Multiply these two columns. Yes, come on. So one student has got it. Very good. 920 point something. So if you are getting 920 point something, one student got 920.46. That is also right. No problem. Because of discounting and present value, sometime difference come because of rounding off. Somebody may take 4 digits, somebody may take 3, somebody may take 5. Somebody can directly calculate also. Now what you do, you multiply year and present value. Present values are being used as weights, that so much cash flow has been recovered in year 1 itself. So much cash flow has been recovered in year 2 itself. So please multiply 55.55, then 102.86, 142.88, 176.4. Please reply 3607.18 and tell me the total of this also. 4084.89. Check the answer. If you are close to this number, you are right. 4084.89. Are you close to this number? Yes. So students have confirmed this amount 920.15 is also called intrinsic value of bond or present value of bond. Okay. And now we will calculate the duration. Duration is the total of this column divided by this column, and your answer will be less than 5. So write down below, duration of bond is equal to 4084.89 divided by 920.15, that is 4.44 years. 4.44 years, correct? Divya is getting 4086. Okay, you can take 4086 also. So you will write, those who got 4086, write here 4086. No problem. and keep about half page blank, because I have to solve. There are 2 more questions, but that is for later part. We have not yet discussed modified duration and how to calculate revised bond price. So keep approximately 20 lines blank below this. Okay, when you write something next, keep 20 lines below this. Done? Is the answer 4.44 right? Now, after keeping 20 lines blank, come to your book. Just above question number 42, there is one alternative formula to calculate duration. So there is a formula also, alternative formula. This is one formula, summation of PV into year divided by summation of PV. That will require the use of this table. There is one more formula. If you can remember this formula and learn its application, you can use this also. This will be little faster, but then it will consume some megabyte of your memory. Okay, so invest in this formula. The formula is CY upon YTM. Then your question is, what is CY? CY means current yield. In your book I think I have written. If not written, write down CY means current yield. Formula is printed in the book, so don't write. In bold letters it is printed. So CY stands for current yield. YTM is yield to maturity, that you know. CY upon YTM into PV annuity factor. PV annuity factor of YTM and number of years you will take into 1 plus YTM plus 1 minus current yield upon YTM into N. So I'll repeat the formula. Current yield upon YTM into, you have to multiply by PV annuity factor of YTM and given number of years into 1 plus YTM plus 1 minus current yield upon YTM into N. N means number of years. N is number of years. Okay. So in short we will say current yield upon YTM, we will call it yield ratio. PV annuity factor you already know. This is 1 plus YTM is called YTM factor, plus again 1 minus yield ratio into number of years. Now see one small shortcut formula. Shortcut formula will be applied only when the bond is trading at par. The bond is trading at par. Now tell me, bond is trading at par, current yield is equal to YTM, N is equal to coupon rate, N is equal to coupon rate. Just write coupon rate. We have proved yesterday in one of the discussions that if bond is trading at par, redeemed at par, coupon rate, YTM, current yield are equal. Now you see the shortcut. If current yield and YTM are equal, what will be the value of CY upon YTM? CY upon YTM will be equal to 1. Very good. So if it is 1, here my formula, this portion 1 minus 1 will become 0. So this entire thing will become equal to 0 and we are only left with this much. So my shortcut formula is duration equal to yield ratio will be 1, this will be 1, so this portion will become 0. So you just have to multiply by annuity factor into YTM factor. Is it right? So the shortcut formula for duration, if the bond is trading at par and redeemed at par, is annuity factor into YTM factor. Annuity factor will be present value annuity factor for given YTM and number of years, and YTM factor means 1 plus YTM. So in one question I am going to use this shortcut where I am sure that the bond is trading at par, so it will save time for me. Is it right? Now come back to question number 42. Question number 42, I am going to solve by applying this formula. Okay. So in question number 42, write down alternative method. You have kept 20 lines blank. Now write down alternative method. Alternative method, write this big formula. Have you written the formula? But I need to do one calculation before I can use the formula. I need to calculate the current yield. I need to calculate the current yield. Current yield is annual coupon upon current price of the bond. Annual coupon upon current price of the bond. Annual coupon upon current price of the bond, 60 divided by 920.14. So how much is that? 6.52. Okay. Now apply that in the above formula. So write down duration is equal to 6.52 divided by 8. 6.52 divided by 8. 8 is the YTM into PV annuity factor, 8% comma 5 year, 8% comma 5 year into 1 plus 0.08, 1 plus 0.08 plus 1 minus 6.52 divided by 8 into number of years 5. I am going to simplify this for you and then you will give me the answer. 6.52 divided by 8. 6.52 divided by 8 is 0.815. Annuity factor at 8% and 5 year is 3.9927. 3.9927 into 1.08 plus 0.185 into 5. Give me the answer now. Dear student, please reply. What will be the final answer of this? You will first complete this calculation, then you do this calculation. So one student has replied, the answer is 4.43 or 4.44, and you will be happily surprised that this answer is same as the earlier answer which we have solved by preparing a table. So now you are convinced. Now you are convinced that whether you solve by formula method or by tabular format, your answer will be same. So depending upon how the data is given to you, accordingly you solve. Okay. Any query on this alternative formula? Now we have solved the question which was annual coupon paying bond, but there can be question of semi-annual coupon paying bond. Then your duration will also come in semi-annual form. We have to convert into annual. Okay. So if the bond does not pay coupon annually, printed in the notes, we have to calculate duration in period and then convert duration into years. So in case semi-annual bond, quarterly coupon paying bond is given, first to calculate duration in periods and then convert into number of years. Now the student has a query, sir, why we are learning duration? We have only learned the calculation aspect of duration. Now we'll see the application. It has got huge application in management of bonds, and one day when you will also become, let us say, a bond manager, fund manager in a bank or mutual fund or insurance company, then this knowledge of duration would be useful to you to understand the risk involved and also to understand how to mitigate the risk, how to reduce the risk using this tool called duration. So first thing you should know, duration is an indicator of interest rate risk of a bond. Duration indicates the market interest rate risk, which means higher the duration, higher will be the risk for a given change in the YTM. Higher the duration, higher will be the change in the value of the bond for a given change in YTM. So that is why, in case if you are a fund manager and you don't want to take high risk, what will you do? Do not invest in bonds with higher duration. Invest in bonds with lower duration. Okay. So the second line says, higher the duration, greater will be the change in the price and riskier the bond. So for the same change in YTM, the bond with higher duration will find higher price sensitivity. So duration is basically a price sensitive measure. Duration measures, as we will see ahead, duration will help us to calculate by what percentage the bond price will change if yield changes by a certain percentage. So if I know that the RBI is going to increase the interest rate by 0.25%, I can immediately sense that my bond portfolio is going to change by so much percentage, and I will accordingly take my position. If I know that RBI is going to increase the interest rate by 0.5%, I will know by this percentage my bond portfolio will change and I will take my position accordingly. So it's a price sensitive measure. Higher the duration, higher the risk to the holder of a fixed rate bond. So we have to understand that duration helps us to understand the riskiness involved. Higher duration indicates higher risk to a bondholder. Okay, for a given change in YTM, the price will fluctuate more if duration is higher. Now next thing is duration of every bond except a coupon bond, which is our property. Next property, question 43, duration of every bond except a coupon bond is less than its term to maturity. Do you agree? Duration of every bond except a zero coupon bond is less than its term to maturity, because all other bonds generate cash flow. Zero coupon bond does not generate cash flow. Zero coupon bond generates only one cash flow on maturity. So whatever is the maturity of the zero coupon bond, that is the duration of a zero coupon bond, because all cash flows are received on maturity. So only in case of zero coupon bond or deep discount bond, duration is equal to maturity of the bond. In all other coupon paying bonds, all other bonds which pay coupon or some portion of principal, their duration will be less than its term to maturity. So come to question number 43. For the first and the last time, we are going to calculate duration of a zero coupon bond, just to show you. After that, don't calculate duration of a zero coupon bond. If it is a 5-year zero coupon bond, its duration is also 5 year. So please write down in your book, if you have the book, and if you don't have the book right now, or if you have not taken the printout, then you can write in notebook. So write down answer 43, but first you have to also write this question also. It's a 5-year zero coupon bond whose face value is 1000 and the required return of the investor is 8%. 5-year zero coupon bond, required rate of return is 8%. Find out its duration. Find out its duration. So what you will do, 5-year 1000 rupees, PV factor write down 0.6806. PV factor 0.6806. Multiply first cash flow into PV factor, you get present value. Then multiply present value into year, you will get 3403. Then compute the duration of the bond. 3403 divided by 680.60. Amazing. Your answer is 5 years. Such a gross wastage of time, because first you are multiplying by the same number 5 and then you are dividing also. So you are going to reach the same place. But after this we will not calculate the duration of zero coupon bond. This was just to demonstrate. Have you done? Have you done? Yes or no? Okay. Now the next property, which is in the form of question number 44. It is a property of duration. Bonds of longer tenure will have higher duration than bonds of shorter tenure, which means that if one bond has 10-year maturity, one has 5-year maturity, so the one which has got 10-year maturity will have a higher duration. So that means there is a direct relationship between the tenure and duration. Higher the duration, higher the tenure, higher the duration. A 10-year bond will have a higher duration than a 5-year bond. So there is one example in your book. Calculate the duration of the 6% 7-year bond given YTM is 8% and face value is 1000. Now if you look at this example in question number 44 and if you read question 42, there is one small change I have done. Question number 42 previous page have 5-year maturity and this question 44 has 7-year maturity. I have kept other figures as it is just to prove that the 7-year bond will have a higher duration than a 5-year bond even if their coupon rate is same, YTM is same. Let us check. Those who have the book or who have got the printout of the notes can write there only. I have given you the format. So first 5 columns are same. Then you write down year. It is a 7-year bond. I have changed the question from 5-year to 7-year. Cash flow will be 60 rupees for first 6 year and last year will be 1060. Present value factor first 5 year you can copy from your previous answer 42. Calculate for 6th year 0.6302 and calculate for 7th year 0.5835. Now calculate the present value. Multiply these two columns. Give me the total. Let me see who will give me the total first. Who will give me the total first? I am waiting for your answer. Please reply. Anybody who got the answer? Yes, come on. Anybody who got the answer? 895.87. Is it approximately 895.87? Yes. Last 2 digits after decimal can be different. Still you are right. One student have got it. Now next column is multiply these two columns and you use memory plus function also. 1 into this equal to memory plus. 2 into this equal to memory plus. Similarly continue, and after you have done all the 7th year, memory recall function. So what is the total of this last column? Total of the last column is 5238.32. Check the answer. 5238.32. 5238.32. 5238.32. This is the total of the last column. Is it right? Yes, students. Okay. So if you have got it, write below duration of the bond. Duration of the bond 5238.32 divided by 895.87. So which comes to 5.85 years. So have you noted that this duration is higher than the duration of question number 42, which proves that if the term to maturity is higher, duration will also be higher. So I have proved my next property. Bonds with higher term to maturity will have higher duration. So now we'll come to another property which is in your book, question number 45. Duration and coupon are inversely related. Duration and coupon are inversely related. Sir, what does that mean? It means if coupon rate is high, duration will be low. If coupon rate is low, duration will be high. And it is very simple to understand. If coupon rate is high, you will get more cash flow. So if you get more cash flow in earlier year, the weightage of earlier year goes up and therefore your duration is lower. But if the coupon rate is low, you get less cash flows. And if you get less cash flows, you get less weightage in earlier year and therefore the duration is higher. Okay. So there is an inverse relationship. So there is a question in your book, question number 45. Calculate the duration of the 7% 5-year bond given YTM is 8% and face value is 1000. Compare this with question number 42. In question number 42, the coupon was 6%. In question 42, coupon was 6%. In question 45, I have changed the question myself to 7%. Just to tell you that higher the coupon, lower the duration. So this time my answer should be lower than the answer of question number 42. Yes or no? So please start solving. Year write down 1, 2, 3, 4, 5 and cash flow this time will be 7% of 1000. So 70 rupees, 74 times, last year write 1070. Copy the factors from previous question, don't waste time. Calculate the present value. Let us see who will give me the answer first. Come on, student. Who will give me the answer first? I am waiting for your answer. Yes, anybody answer? One student have given the answer, that is 960.08, but your answer is different. So please check your answer again. Please check your answer again. The one who has given the answer 897.96, check the answer again. Okay. And now you multiply year into present value and take the total of the last column, 4198.54. Otherwise what you can do, you can just note down these two numbers and you can check it later. Okay, note down these last two total and check it later as homework. So what will be the duration of this bond? Write down below. Duration of bond is equal to 4198.54 divided by 960.08. 4.37 years. 4.37 years. Is it 4.37 years? Now you see, this 4.37 year is lower than the answer you have got in question number 42. The reason being, this time the coupon rate is higher than the coupon rate of question 42. So I have again proved higher the coupon rate, lower the duration. Higher the coupon rate, lower the duration. Okay, and now next is question number 46, which is a property of duration. Duration is inversely related to market interest rate or yield. Duration is inversely related to market interest rate or yield. 1 second please. Duration is inversely related to market interest rate or yield. What does that mean? If YTM is higher, duration will be lower. If YTM is lower, duration will be higher. Because if YTM is higher, the present value becomes lower, because high discount rate will make it the present value lower. So the weightage goes down. Earlier year cash flows weightage will go down and therefore the duration would be lower. So there is an inverse relationship between duration and YTM. Lower the market yield, higher the duration. So there is a question in your book, question number 46. Calculate the duration of 7% 5-year bond given YTM is 10%, face value is rupees 1000. Okay, this we are going to compare with question number 45. Compare with question number 45. Compare this with question number 45, because all factors are same except that the YTM which I have used in question number 45 was 8%, I have made it 10%. So now what will happen? If you use a higher discount rate, your present value will fall, your duration will fall. So write down the answer in your book. If you have the book or the printout of the notes, copy this first two columns, but your discounting factors will change this time. Discounting factor will be at 10%. 1 divided by 1.10 equal to. Now good students will immediately start solving for present value. I'll give you 5 seconds. Give me the answer of present value column total. 5 seconds starts now. Okay, total. Anybody? Use memory plus function. Multiply equal to memory plus. Multiply equal to memory plus. and your total is 886.25. Muralidharan is right. Very good. Amazing. And now you do the same thing. You multiply year into present value. Use memory plus. Year into present value equal to memory plus. Equal to memory plus. Multiply equal to memory plus. Check the answer. Anybody? Total of last column. $3848.15. Check the answer. 3848. After decimal it is slightly different. It is okay. Okay. So now write duration, and you will find that this answer of 46 number is less than question number 45. So which proves that higher YTM will result into lower duration. Right. Duration is equal to 3848.15 divided by 886.25 divided by 886.25. Is the answer right? So this 4.34 you will see is lower than previous answer, question number 45. So that proves that higher YTM results into lower duration. Next property of the bond is higher frequency of intermediary cash flow reduces duration. Higher frequency of intermediary cash flow reduces duration. What does that mean? What does that mean? It means that suppose one is an annual coupon paying bond. So annual coupon paying bond will pay you coupon at the end of 12 months, 24 months, 36 months, and there is a semi-annual coupon paying bond which will give you coupon at the end of 6 months, 12 months, 18 months, 24 months. So now what will happen? Which one will have lower duration? Which one will have lower duration? A semi-annual bond where some cash flow you receive in 6 months itself. Some cash flow you receive in 18th month itself. So that will have lower duration compared to the one which is an annual coupon paying bond, because earlier you receive cash flow, your duration will keep on reducing. A quarterly coupon paying bond will have a lower duration than a semi-annual coupon paying bond because your cash flows are recovered earlier. So I have written this note also. The bond paying semi-annual coupon paying bond will have lower duration than bond paying annual coupon. Here I am not taking a question because it is very easily understandable. If you receive cash flow in 6 months and if you receive cash flow in 12 months, the one which is received in 6 months is received early, so therefore its duration would be lower. Now next property of the bond is, suppose you have more than one bond in the portfolio. Your portfolio comprises of more than one bond. So what is the overall duration of the portfolio? The overall duration of the portfolio will be the weighted average duration of all the bonds in the portfolio. What do you mean by weighted average? Weighted average means how much amount you have invested in the bond. The amount invested in the bond will be used as weights. Okay. So I will give you one example. Print in your book question number 48. First you write down these details. Write down in your book bond A, bond B, and in bond A we have invested 20 lakh. In bond B we have invested 60 lakh. Total investment is 80 lakh. So assign the weight 20 lakh out of 80 lakh means the weightage of bond A in the portfolio, the proportion of bond A in the portfolio is 25%. So 0.25, and proportion of bond B in the portfolio is 60 by 80, 75%. And the duration I have given For example, say take 3.5 and 4.6. So how do you compute the duration of the bond portfolio? Multiply weight into duration. Multiply weight into duration and take the total of the last column. Anybody, total of the last column? Total of the last column. So you multiply weight into duration and give me the total. So total comes to 4.35. So the overall duration of this portfolio is 4.35. The overall duration of this portfolio is 4.35. So these were the properties of the bond. These were some of the properties of the duration of the bond. Okay. Now the next thing we will learn, what is the relationship between duration to the bond price changes. How the bond price will change if you know the duration of that bond. If YTM changes by 1%, by what percentage the bond price will change if you know the duration. So duration will help us to calculate by what percentage the bond price will change for 1 unit change in YTM. Okay. So see, there is a mathematical relationship. In paragraph number 29, you have to write. Okay. You have to also write so that you will also participate. Write down the equation, write down percentage change in price is equal to minus D into percentage change in 1 plus bond yield. Percentage change in price is equal to minus D into percentage change in 1 plus bond yield. That is a relationship. Now we'll put it mathematically. What is this symbol, triangle symbol? It is called delta. It is a symbol of change. Okay, it's a symbol of change. So delta P means change in the price of the bond divided by the original price of the bond. So delta P upon B gives you percentage change in price is equal to minus D into change in YTM. Delta Y means change in YTM upon 1 plus YTM. This formula has been derived. It's a derived formula. So we will not be able to derive it in the classroom because the source of this formula is in 12th standard mathematics or in CA foundation mathematics. There was a topic called derivative and integration. So the formula has come from there. So right now neither you nor I know anything about derivative and integration. So this is the relationship between change in the price of the bond and duration. So can we write down further as follows? Minus delta P upon P equal to minus D upon 1 plus Y. I have just shifted 1 plus Y below minus D into delta Y. Noted. Now you look at it carefully. This portion D upon 1 plus Y, D upon 1 plus Y, this portion D upon 1 plus Y, there is a name to this and that is called modified duration. Modified duration. D upon 1 plus Y, Y means YTM, is called modified duration. So what is the process to find out the percentage change in price? First calculate duration. Duration upon 1 plus Y is modified duration. Modified duration multiplied by change in yield will give you percentage change in the price of the bond. For example, if modified duration is 3.5 for example, and change in yield is 0.5, which means the price of the bond will change by, how much is that? 1.75%. Price of the bond will change by 1.75%. Now, what is the purpose of this minus sign? You have not asked me. Okay. So, from tomorrow I will keep your speaker on, those who are learning at home, so you can ask the question also. So, the purpose of minus sign is, if the YTM increases, bond price will decrease. So, that minus sign indicates inverse relationship. If YTM decreases, bond price will increase. So, that is why I put a minus sign indicating inverse relationship between the change in YTM and bond price. Okay. Up to this, any query? So, have you written this note? Write one note. I'll dictate. Write a note. Minus sign indicates there is inverse relationship between YTM and bond price. There is inverse relationship between YTM and bond price. There is inverse relationship between YTM and bond price. And next, write down D upon 1 plus Y. D upon 1 plus Y is called modified duration. D upon 1 plus Y is called modified duration. So, if you know duration, you can calculate modified duration. Modified duration multiplied by change in yield will give you change in the bond price in opposite direction. In opposite direction means if yield goes up, bond price will fall. If yield goes down, bond price will increase. So, my next paragraph number 30, modified duration. Modified duration is a modified version of Macaulay's duration. Duration concept was given by an economist called Macaulay. So, sometimes also called Macaulay's duration. Modified duration is a modified version of Macaulay's duration which accounts for changing interest rate. So, what is the purpose of modified duration? Modified duration says that by what percentage bond price will change if YTM changes by 1%. So, if modified duration is 3.5, it means if YTM changes by 1%, bond price will change by approximately 3.5%. If YTM changes by 1%, bond price will change by approximately 3.5% if modified duration is 3.5. Now, I am using the word approximately because modified duration does not give you accurate answer. Modified duration also does not give you accurate answer, but it gives you approximate answer as long as the change in YTM is not very high. If the change in YTM is low, like 0.1%, 0.2%, then modified duration is very close to the accurate answer. But if change in YTM is higher, then modified duration does not give you accurate answer. So, modified duration is also used for calculating the volatility of a bond. Volatility of the bond means by what percentage bond price will change for 1% change in YTM, and modified duration helps you to do that. So, the formula for modified duration is duration upon 1 plus YTM. Now, students will please go to question number 42, and I had asked you to keep 20 lines blank. Go to question number 42 in your notebook. Question number 42, and the answer of modified duration is pending there. So, write down now in that blank 20 lines, modified duration is equal to modified duration is equal to duration upon 1 plus YTM. Duration upon 1 plus YTM equal to 4.44. Can you see 4.44 is your duration? Divide by 1.08. Divide by 1.08. So you will get 4.11. Modified duration is 4.11, which means that if YTM changes by 1% from here, bond price will change by approximately 4.11%. If YTM changes by 1%, bond price will approximately change by 4.11%. Now next paragraph in your book. Next paragraph in your book. Paragraph number 31. Paragraph number 31. Volatility of a bond is the change in the price of the bond due to change in the interest rate. And how do you compute that? You compute that with the help of modified duration. Modified duration is used as a measure of sensitivity of the bond price changes to changes in the interest rate. Same thing I am telling you. Modified duration tells you if YTM changes by 1%, by what percentage bond price will change. So the formula for calculating percentage change in bond price, very easy, minus modified duration into change in yield. Why minus sign? Inverse relationship. Okay. Minus sign indicates there exists an inverse relationship between bond price and yield. That is, if yield increases, bond price decreases. If yield decreases, bond price increases. So in question number 42, once again question number 42, they have asked you to calculate, in question 42 they have asked you to calculate the percentage revised bond price if YTM reduces by 5.5%. Is it there? Write in your notebook. Write in your notebook percentage change in bond price. Percentage change in bond price, or you can write in paragraph 31 also, there is some space. Percentage change in bond price is equal to, the problem says YTM reduces by 0.5. So minus 4.11 into minus 0.5. So minus minus will become plus. So bond price will increase by 2.055%. Bond price will increase by 2.055%. So what will be the revised bond price? Take the original price in question 42 plus 2.055%. New bond price equal to, new bond price is equal to, your original answer if you see in question number 42 is 920.15 plus 2.055%. So that is equal to 939.06, which means using duration concept, finally I am able to calculate what will be the revised bond price if YTM changes by 0.5%. That was the advantage of learning this duration. Then the student can ask me, instead of doing so much, I could have simply discounted the future cash flow by 7.5%. Yes, you can do that also. So come to your paragraph number 31. There are two ways you can get the revised bond price. One is by applying duration concept and one by simply calculating the present value. This present value will give you more accurate answer. Duration will give you approximate right answer. So for the same question, now I am going to calculate the present value of the bond, revised value of the bond using 7.5% discount rate. Okay, right. You can write in the notebook or you can write in book paragraph 31, wherever you please. calculation of present value of the bond. Calculation of present value of the bond. 4 columns we will draw. Year, cash flow. Now we'll take discount rate 8 minus 0.5, 7.5%. Discount rate 7.5% and DCF. Okay. Then you solve. Year 1 to 5, 60 rupees. 5th year, 1000 rupees. Factor. Check the factor at 7.5%. 4.0459, 0.6966. Then multiply. Take the total. Multiply and take the total. How much is the answer? Yes, anybody, how much is the answer? 939.30. Very good, amazing. And you will find there is a difference in the two answers. And that difference is because present value method gives you accurate answer. It considers time value of money properly. Duration does not give you accurate answer. It gives you approximately right answer. Okay. Why duration gives you approximately right answer? We'll tell you tomorrow. Okay. So today we'll stop here. Thank you very much. Bye bye. Take care and come tomorrow, all of you, at time 7 o'clock.